Good morning, everyone. It's exactly a year ago since the Monetary Policy Committee last changed the stance of monetary policy by increasing the scale of asset purchases to £200 billion. Since then, at each meeting, the committee has decided to maintain a high degree of monetary stimulus in order to balance the conflicting risks to the inflation outlook. In the past year, our economy has begun to recover and GDP growth has been above its long-run average. But whether that recovery will be sustained depends heavily on developments in the rest of the world, as domestic spending, especially by the public sector, is likely to grow more slowly looking ahead. And given the scale of the fall during the recession, the level of output is likely to remain weak. Despite weak demand, inflation remains more than a percentage point above our 2% target. There's no shortage of explanations for the current high level of inflation. The exchange rate on average remains about 25% below its level in mid-2007. There have been sharp gyrations in global commodity prices and sizable changes to VAT. It's not surprising that the combined effect of all of these factors has led to movements in inflation that are larger than those experienced in the period 1992 to 2007. Indeed, were it not for these factors, our inflation experience might well have been closer to that in the United States, with inflation about as far below as it is currently above our target. Given the quantitative importance of the different influences buffeting the economy at present, it's hard to judge how inflation will evolve in the medium term, and there are sizable risks in both directions. On the one hand, slack in the economy is likely to reduce inflationary pressure. Unemployment at almost 8% is high, and growth in money wages has been subdued at around 2%. If the weakness in wage growth were to continue, then once the temporary effects of higher import prices and VAT wane, inflation could move substantially below the 2% target. On the other hand, inflation has been above the target for much of the past 3 years. It's possible that additional import price pass-through or further commodity price rises will push up on inflation. And if the period of above target outturns causes medium-term expectations to drift up, then the inflation outlook could be significantly higher.